This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archive.
Episode 101. Why government debt isn't a problem.
Welcome to the Debunking Economics Podcast with Professor Steve Keen. I'm Phil Dobbie, and today, why is government debt not such a big problem, while private debt is? We know mainstream economists, and in particular politicians, point to government spending as something that needs to be reined in. Otherwise, we get hit with massive repayments that soak up all the money that could be used on useful things. So, why are they wrong on this? That's today on the Debunking Economics Podcast. Well, Joh Madden has sent us a message saying he wants to understand, in simple terms, why the interest payments on public debt are not a problem. He points out how it's used to justify austerity because it intuitively makes sense to waste less money on paying interest. And he wants to know why this interest is not a problem and what if the money which the public owes keeps rising. So let's start with Theresa May, November last year, saying that we spend nearly £50 billion in payments on interest in the UK to those we have borrowed from as a result of the legacy, of course, of the Labour Party. So maybe step by step, let's start with who would they have borrowed from. That first step is, of course, when the government needs money, they get the Bank of England to issue bonds, or gilts, as we call them over here. So take it from there, in simple terms.
Okay, well, let's start from just further down the road. Let's start in Parliament House, because this is where the whole thing begins. Because the government will come up with a budget, where the budget estimates what they think its spending is going to be, and of course they've got fairly good estimates on spending because, except for the impact of unemployment benefits, but they've got estimates of spending. They have estimates of taxation. There'll be a gap between the two. So what the government will do is tender its I've forgotten the term that's used in supply bill. Is the term we use in Australia. I imagine it's the same here. The bill for supply, and the bill for supply, as well as saying this is what we expect for tax and our expenditure, the gap between the two, the bill is to authorise the issuance of bonds to cover that gap.
Yeah.
And that's stage one. Okay, so let's say
in most people's minds, people understand that, and they would then say, so people buy those bonds and they expect a dividend on those bonds, and so that's the cost of servicing that debt.
Yeah, okay, that's the overall perspective. Now, I'll take the simple approach, and I might try a slightly more complicated version of this later, but what the government then does is the bonds are issued. Now, as soon as the bonds are issued, and this is if you and I decided to issue Steve bonds or Phil bonds, we couldn't go shopping immediately with the money. We could not credit our bank accounts with the amount of the bonds we issued. The government's different. As soon as the bill is passed, the Bank of England now regards the Treasury as having that money in its account. So
right. Hang on a sec. Yeah. Hang on, because we're doing this step by step.
Yeah.
I issue bonds. People give me money for those bonds. Why can't I spend that money straight away?
No, people haven't. You haven't sold them yet.
No,
okay.
Cool.
Before you sell them,
there's that slight problem.
That slight problem.
Okay.
You got to sell them. Okay. Okay. Now the government doesn't.
And no one would want to buy them.
Damn.
But exactly. But government bonds, different story, because you know you're going to get the money. That's
right. Okay. So what the central bank does is said, okay, we're going to treat your bank account as if those bonds have already been sold. So you just keep on spending. Right. Then the bonds are sold. Now, when the bonds are sold, they are sold normally to institutions in the financial sector. Okay. So. Okay, if the government spends all those, sells all those bonds to the financial sector, then the financial sector gains bonds, and the government gets money from the financial sector. So there's no creation of money going on there because there's a transfer of money from the financial sector to the government. Now, with that money in its hand, the government then spends, and that money then goes to let's say the real economy. Now, in the real economy, with the buying and their profits and wages, et cetera, people then end up buying financial instruments to try to save money, which means the dollars, the pounds, then reaccumulate back in the financial sector. And the government repeats the process because I've ended up with a more complicated description to begin with, but what you have is a circulation of money. If you imagine what's going with the government, let's say it's just a £10 billion issuance of bonds. So the government sells £10 billion worth of bonds And it's spending 100. So it's been spending 90 out of tax revenue and an extra 10 out of selling the bonds. So it's sells 10 billion pounds worth of bonds to the financial sector. The financial sector transfers 10 billion pounds to the government. Over the year, the government then spends 100 billion pounds per year, dimensioned by time, per year spending, and the private sector then goes back and saves another 10 billion of that. So you get 10 billion pounds reaccumulating back in the financial sector, and the government then repeats the process. So what you've got effectively by the bond sales is the government is stopping that money accumulating in the financial sector, taking it out by exchanging the money for bonds, and the money intends being spent through the whole economy again. So you've got in that sense, that the main role the bonds are playing is to continue the circulation of the money that's already been created before the government issued those bonds. So it's a circulation of money. That's the first stage, yeah.
Right, okay, well, let's make sure we're right on that first stage, because we're all on the same page. So the government's got a £10 billion pound shortfall, for example. It issues £10 billion pounds worth of bonds. They get that money straight away, and that money is pumped into the economy and ends up with us, normal people. And a chunk of that money that we then get, we use it to buy stuff. But some of that we also say we want to save some stuff. We want to start saving some money. So that goes back into the financial sector, and the financial sector uses part of that to pay off some of these bonds that they've been buying.
Yeah, well, it's a circulation process. So what you're doing by issuing the bonds is making sure the existing amount of money continues turning over. If you don't do that, if the government spends 100 billion per year, and of that 100 billion, people are saving 10 billion per year, then your money stock is falling by 10 billion pounds. In terms of the active money stock, the money stock actually turning over in the economy, is falling by 10 billion pounds per year. So the sale of the bonds is actually necessary to keep the circulation process going. Now, this is, believe it or not, this is a recent insight, and I can actually thank Stephen Lawton for making me realise it. I sent him the haiku diagram. He described the diagram as being obviously from my cubist phase, but in looking at it, a large part of that bond sales is no money creation going on, because you're simply selling the bonds to the financial sector and they're handing over money which is accumulated in the financial sector. But unless you do that, the active money circulation declines. So a large part of the bond sales actually is to keep the existing money stock turning over and continuing being created. Now, the question, of course, we've got to get to next is, okay, that's the circulation of money. What about the interest payments?
Yeah, well, that's it, because they still appear as a line on the government's budget. So because the government is having to pay those interest payments on those bonds. Well, it's actually paying the dividends on those bonds.
Yep. But the way that, if you imagine that let's say it's a 10% rate of interest, which is much higher, of course, than actually applies, but it rounds out our figures. So when you issue those 10 billion pounds worth of bonds, you're also promising to give the financial sector a 1 billion pounds per year flow of interest on those bonds.
Yeah.
Now, where do you think the money comes from?
It'll come from it comes from the government, so it comes from the budget. Therefore, it adds to the deficit.
It comes from the Bank of England. Okay, because the financial institutions. You think about the balance balance sheet of the Bank of England now. It's got the responsibility of financing those bonds. So what it has to do is has to credit the accounts of the financial institutions that own that money. So it's putting a plus in their accounts. Now, that can be...
Well, hang on. If that is the case, then the government is saying, hey, look, we need £10 billion, so issue £10 billion in bonds. We're not going to pay any interest in it. You are.
Well, the central bank pays it. And this is if what is then happening is the central bank is then crediting the accounts of the financial institutions that have bought these bonds with 10% of the value of the bonds each year, which is an accounting operation for the central bank. It is not. It doesn't have to tax to finance it.
But are they paying it? Because when you look at the government budget, they are saying, well, this is how much it's costing us to service debt. They're not saying it's the Bank of England is paying it. They're saying we're paying it. But it's being added to the bottom line for our budget.
And that means that when they want to issue, when they've got a budget where they have a 90 billion covered by tax and 10 billion by issuing bonds, and they're paying 10% on the bonds, they issue bills to authorise 101 billion, so 11 billion rather than 10 billion, and the extra 1 billion is what pays the interest. Now that, again, because the money is credited, the central bank credits that amount of money to the Treasury. Effectively, that $1 billion is paid to the equity of the central bank, which it can then use to pay the interest on the people who the bonds are sold to. So it is all an internal accounting operation. And yet what it does, though, it generates an income stream to the financial sector, which then means the financial sector has a stream from the government that it can use for its own payments of people who've bought bonds, from the non-bank sector who've bought bonds off the financial sector or have insurance products and stuff like that. So again, right. It's still. I
can see. I sense Joh Madden is getting confused now, and quite rightly, because I am. But I think this is the nub of the nub of the issue, which we might have passed over too quickly previously. I'm the government. I want £10 billion worth of bonds. The central bank issues those bonds and pays me the money straight away. They then sell it onto the financial sector. The financial sector says, that's all cool. I need £1 billion in per year from you in dividend payments or interest, call it what we will. And you're saying, okay, the Bank of England says no problem at all. We'll create £1 billion because we've got that ability to do that and give you that £1 billion. But the government is still saying, well, we owe. That's actually an interest payment on the debt that we've created, and we are counting it in our budget. We've got that £1 billion sitting in our budget. So that is that's a cost. And sure, we can say, well, okay, we'll use that. We'll add it to it. It's just part of our bottom line. That's in the negative. We need to issue more bonds to cover those interest payments,
which they do.
Right.
Yeah.
So this gets back to John's point. So how long can you keep on doing that? Because that £10 billion actually becomes £11 billion. Then next year we've still got that £10 billion shortfall. So we've now got 20 billions of bond issued plus 2 billion in interest payments, and so it goes on, and so it escalates. At what point does it become a problem?
Well, it doesn't, so long as you still have the Bank of England's notes being accepted as money inside the UK, and that's what happens. It is an accounting operation, and the whole thing could be a total accounting operation. The government doesn't have to sell the bonds. It doesn't have to get the money by selling the bonds to the financial sector. You made a slight procedural error in what you were talking about beforehand.
That's true, I would.
I know. You're allowed to. You're the journo here. I'm the economist. And I don't know this stuff as well as I should, I might add, in terms of the actual mechanics in each particular country. But when you have the bills being the spending bill, the supply bill being passed, then at that point the central bank pays as if the bonds have already been sold. They haven't been sold. They're sold at a later auction. And when they're sold at a later auction, then the money actually turns up in the accounts of the Treasury, because it's the bonds are sold on behalf of the Treasury by the central bank, but by law the central bank is not allowed to buy those bonds directly. However, it can buy those bonds back off the financial sector through what they call open market operations. So all the way through the year, and very, very it's the biggest market in the world in that sense, the bonds market. There's buying and selling of bonds by the central bank to the financial sector all the time, trying to enforce the reserve interest rate target they've already set. So they're pumping money in and out of the financial sector all the time. Now, with quantitative easing, and this is one reason that I think I'd like people to think in terms of quantitative easing about all these issues, because QE is A, so big, and B, had no direct impact on anybody's tax receipts, that it makes the case unarguable. For the last 10 years, pretty much, the British Central Bank, the Bank of England, has been spending £200 billion per year on quantitative easing. Now, what tax did you pay for that? Which is creating. Well, they have in that situation created money. Exactly. Well, they've created money for the financial sector, but there's been zero tax to finance it. They didn't. All they have to say is, we'd like to buy. What they're doing actually is, in terms of the open market operations, they've told the financial sector they're going to be on the buy side to the tune of £200 billion per year. Regardless of what the volume is in the market, they're going to make sure they're buying £200 billion additional bonds every year off the financial sector. Now, and those bonds can be not just government bonds, they're mortgage-backed securities and all sorts of stuff. But to finance it, zero need for taxation. is to say, we're going to credit your account with $200 billion, and in return for us crediting your account, which is the liability of ours for $200 billion, you're going to give us bonds worth, which you notionally value at $200 billion, that we're going to put on the asset side of our ledger. And they've been doing it for 10 years. Now, I use the example of $10 billion as a government deficit. That's, it's in the same ballpark as the scale of the government deficit in the UK. It's not $100 billion. It's of them were closer, it's in tens rather than hundreds. People have been saying, how do they pay the interest on $10 billion when we're talking a rate of interest which is below 10% again? But at the same time, QE's been...
So with QE, that's what happens. Of course, yeah, I know. Lots of money, absolutely, and not just in the UK.
Global.
In many countries around the world. Yeah. So, including Europe, and and delaying trying to stop it. When they do stop it, when they wind it back,
that's when the fund comes out.
Then they do. Well, then they're selling those bonds back, aren't they?
That's right.
Back to the financial institutions and getting the money back from those financial institutions. And presumably the money goes, just as that money was created, that money gets destroyed, does it?
Yeah, and this also has an impact on the value of financial markets, which is, I think we've covered this once before, but it's worth doing in detail again at a later point. But the major point is, by analogy, what the central banks have been doing with QE, they also do with the capacity to buy the bonds off the financial sector, and it's also what they do to finance the interest on the bonds for the financial sector. So there's no...
But of course, a lot of those bonds will be government bonds. So
sorry.
No, that's all right. So, I think the point you're leading to is here, well, if we can do it with QE, why can't we do it with government debt?
Exactly. And that's the point. We have been doing it with government debt for this whole time. So the fact that it's this terrible burden is like a terrible burden some poor accountant's got to make an entry in 2 columns. Well, damn, I feel so sorry for his hand or his fingers on the keypad, but it really is an accounting operation. There is no limit to it, right, so long as you are issuing your own currency and you are paying the debt in your own currency and you have a central bank issuing that currency. It is all accounting.
Right, but there is a limit. There are repercussions, obviously, if all the bonds... Well, on 2 counts. By the way, there's somebody just got... We can tell I'm working from a home studio now because there's someone starting to mow the lawn.
There you go.
But that's all right. We can live with that. So, on 2 counts, there's 2 problems on. The one is if you keep on creating the money, then you're going to get... in effect, you'll start to see some sort of inflationary impact. But on the other side, there's just no... constraints on government spending.
No, again, it's a wrong analogy. People are making the analogy of the government to a household. And if a household was doing what if you and I were issuing Steve bonds and Phil bonds and having to finance this, the only way you can finance those Steve bonds or Phil bonds is by you doing lots of podcasts and me getting lots of Patreon supporters or giving more guest lectures here, there and everywhere. And if I don't get enough money in that way, then I start running out of it and I've got to start selling assets and finally I'm bankrupt and on the streets. That is the analogy of thinking about the government as if it's a household. But if your household owned a printing press which could produce Philbies, and Philbies were accepted as 1-for-1 with pounds, then all you do is turn up the printing press a bit more and produce more Philbies to continue your extravagant lifestyle. And
so it's a bit of scaremongering with these figures,
isn't it?
It is
scaremongering.
And it's interesting because if you look at it and relate it actually to the household, Theresa May quoted, how much we were paying in terms of interest paid in terms of GDP. If she had done that, I should say, it would be less than 2%.
Yeah.
Which just doesn't sound like a lot, does it?
No.
And actually, at a household level, if you look at the amount of debt we carry, you get a mortgage. 85, in those early years, 85% of your mortgage is paying off your interest. And for most people, the mortgage is half of their income. So 40% of your earnings are actually going on interest payments. We don't seem too worried about that. So 2% actually going on interest payments out of total GDP from government debt, which you're saying isn't really debt anyway, isn't really a big issue.
No, it's not. And this is the whole, it's breaking away from this really, sky is falling arguments about government debt. Is a major part of getting sensible government policy, which we're not going to see, unfortunately, because it's so easy for people to make an analogy from the government, from their own personal situation, to if the government didn't have a central bank. And if the government didn't issue currency, right. It has both. And once you take it into account and see it in terms of double entry bookkeeping, it's just an accounting entry, then there is no limit to their capacity to do it. It's the consequences of them doing it, not the possibility of it being done in the first instance.
Yeah, so what are the consequences, and where does that play? What sort of level does that put the limit at then?
Well, that's again, is your economy overheating? Are you bringing in too many imports? And this is we had a debate, as you know, with Warren Mosler a short while ago, very nice debate, where I disagree with the modern monetary arguments. Because I think they don't take their own logic far enough, that if you run a trade deficit, then you are going to be forced to issue bonds in a foreign currency or to sell assets and gain foreign currency with them. And ultimately, you get in the situation of somewhere like Argentina, where nobody accepts your money internationally anymore. You've got to issue bonds in American dollars, and you can have a depreciating currency. You lose assets, you lose your cash flow. So to me, the real limitation is the ultimate limitation I see is on the impact on the balance of payments, the balance of the current account. That's what I see as the main limitation. But also, of course, if you have a government spending massively into the economy and not taking enough money out via taxation, you can get inflation because you drive up the level of demand too high. You have excessive wages being wage inflation coming out, causing price inflation, et cetera, et cetera. And you can also have them on wasteful projects. This is the other thing.
Which all the roles of the central bank, really to try and ensure that the economy is moderated in that fashion. So, in a way, potentially you are giving them another instrument.
Yeah, it's also the issue of what is actually done with the government money. I mean, Keynes made the argument during the Great Depression that it'd be good to dig up holes and bury money in them and get people to dig the holes up again to stimulate the economy. Okay. A lot of people say, that's pretty wasteful stuff. And it's true, it is wasteful stuff. But what it's doing is creating the money the rest of us can spend. That's I'm a great critic, as you know, of government and bureaucracy. But your government does have one essential role of creating the money the rest of us use, and it can do that in bad ways, like, for example, more Trident missiles, more bombing raids in Yemen. What I would like to see the government creating money for is things like free education. You're giving students finance to say go to university and study for this length of time. The students are doing the spending. The money turns up in Main Street. That's a sensible way to create money for the government, rather better than more nuclear missiles or more military operations. The government could also be building.
So in that nutshell, to answer John's question, then the government has got a shortage of money, so it sells bonds, or it has bonds issued by the central bank. The interest payment or the token payments on those bonds gets paid by the central bank. It gets charged back to the government where it appears as though it's a line on the budget. But that's just an accounting thing. It doesn't need to be. We could just keep on issuing those bonds. The problem is, by issuing those bonds, we keep on reporting back that is a debt. But it doesn't have. But we don't have.
We could actually call it.
Yeah, we gave it another name.
We could call it shares. We could call it shares. The government issues shares, and then what you've got is a share. You get a share, which is a share in the equity of the country called the United Kingdom. And in that case, what you've got is the public owns the shares, and the value of the shareholdings are going up, and everybody starts to smile. It is a very different perspective to debt itself.
Yeah, but you keep on adding to the shares. That's the problem. Shareholders don't like the idea that you're going to keep on devaluing the share by issuing more shares year on year. So maybe it's not an exact analogy like that.
Yeah, but it's a better analogy than seeing it as debt, because there we think in our own household situation, we get totally confused. I've done a few little Minsky models on this front, not elaborate enough yet for my liking, but I might keep on doing that and do a detailed post at some point on the actual accounting. Interestingly enough, in one of the exercises I did, it turned out that the interest payments by the government, by the Treasury, are actually increasing the equity of the Bank of England. So these accounting operations can have actually beneficial effects in some senses, rather than having the negative impact that people think they necessarily have. And it is just because that we accept the government's unit of account as money for our transactions, then the government's creating the unit of account by these operations, including the money it pays as interest, because that then gives the financial sector a flow of income which it can use for its own purposes, nefarious or otherwise. So these are all income flows generated by the accounting capability of a currency issuing government.
So are there any governments that work like this? I mean, is this a bit of the China thinking? Is this why we're seeing growth in China? Because they're following...
Yeah, China's doing a huge amount of this because, I mean, I've seen estimates that China's excess of spending over taxation is of the order of 15% of GDP. And when I mentioned that to one of my very good mates who... he's retired these days, but he was one of the major infrastructure funders in the Asian Development Bank. He said from his experience that's too low an estimate. It's probably 20%. Now, that is an enormous use of the government's capacity to create money to harness real resources. And what it's given us, partly the level of pollution you see in China these days, but it's also all the high-speed rail they've built. It's the Silk Road. They're using the capacity of the state to create money to finance a dramatic expansion in China's political and economic power. And in that sense,
worldwide. So you've also got Chinese government investing in businesses which are then investing overseas. Like, for example, putting in proposals to build nuclear power plants in the UK and that sort of thing.
Yeah. That's the world we live in, and the Chinese know actually. I don't know whether they know what they're doing in that sense. They don't actually understand the actual power and logic, but that's what they are doing. They're being extremely successful.
Yeah. So why if it's also obvious, why haven't governments and central banks cottoned onto this? Why isn't one government saying, well, now we understand all of this, actually getting into debts is not a problem, and we can unilaterally do that and we're not going to suffer any consequences?
Well, the last government that actually did that quite consciously and explicitly was run by a little bloke with a strange mustache.
And it didn't end well for him. But I think...
But what he did, he overpowered Europe with the industrialisation and the military power he could build by using that, by basically ignoring the government deficit as a constraint, saying it's not one. We produce marks. Let's produce lots of marks. And I'm not talking Carl here. And industrialise, employ everybody. And that's why he got the degree of support he got in his own country. It wasn't just the racist attitudes that he had. It was also, he turned it around from being 25% unemployment or more, worse than America, in fact, to full employment in a couple of years. And it was by using this capacity of the state to create money.
So if he'd actually been a good guy and he'd said, well, now we've done that, let's produce better cars and things that we can sell overseas rather than, and seek world domination that way, he might have been a bit of a hero in that respect, rather than the tyrant he was. If only he wasn't a racist, the world would be a different place now, wouldn't it?
That is a rather large statement, but yes. Unfortunately, he got his ideas from another. Racist, and I got quite a bit of surprise to find this out myself. The racist who taught him the ideas about the role of money was one Henry Ford.
Yeah, I've heard that too. Yeah. All right.
Yeah.
Steve, great to talk. Hopefully Joh Madden is now understands this a lot more than he did before. I hope so, anyway.
Well, John, whack a few comments on Patreon, and if we've stuffed it up, I'll try to give a better explanation at a later point.
Okay, good. Thanks, Steve. And by the way, if you're listening and you've got ideas that you'd like us to cover, then you can do the same thing. Either drop us a line via Patreon or at debunkingeconomics.com. Leave a comment there. We'll find it wherever you put it, and we will answer your questions in future editions. That's it for the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Thanks for listening. Catch you next time.